Welcome back to Talk Tickers. We are deep in the trenches of earnings season, and today we're looking at a company that is, well, it's pretty much the opposite of the current tech hype cycle.
Yeah, that's a good way to put it.
We are not talking about building a colony on Mars or, replacing the human brain with a chip next week. We are digging into the plumbing, the enterprise software world.
Exactly. We're looking at Progress Software, ticker PRGS.
And it's a great one to look at because usually when we talk tech earnings, we're looking for fireworks.
Right. Explosions, massive volatility, triple-digit growth, some wild AI announcement that sends the stock flying.
Progress is not that. We're breaking down their Q4 and full fiscal year 2025 earnings. They dropped after the bell January 20th.
And the market reaction kind of tells the whole story, doesn't it?
It really does. So to set the scene for everyone, the stock closed at $38.60, and in the aftermarket, it just ticked up about 2.3% to around $39.50.
It wasn't a rocket ship. It was, like you said, a firm, confident handshake, a respectful nod.
A respectful nod is perfect.
Yeah.
The market is basically saying, okay, we see you, steady as she goes.
And that's the whole narrative here. Investors are buying the cash flow machine story. They're rewarding execution, profitability, not that wild, unchecked growth you see everywhere else.
Which brings us to our mission for this deep dive. Is that cash flow machine label actually enough? Is it enough to drive the stock higher in 2026?
Or is the lack of, let's call it organic Starks, going to act like a governor on the price?
Exactly. We've got a lot to get through. The financials, a huge acquisition integration, and honestly, some of the most sober, realistic AI commentary I've heard from a CEO in months.
Oh, that AI commentary was refreshing. We will definitely get to that. But we have to start with the headlines, the numbers. They set the baseline for everything else.
Let's do it. The number that just jumped off the page for me was earnings per share. They didn't just beat, they crushed it. Non-GAAP diluted EPS came in at $1.51. The street was looking for $1.31.
And let's just pause on that for a second. A 20-cent beat for a company like this, that's massive.
Right. It's not a penny or two.
No. You usually see these mature software companies beat by a penny, maybe 5 cents if they get a tax benefit or something. 20 cents tells you something is working very, very efficiently under the hood.
So what about the top line? Revenue was $252.7 million, up 18% year over year.
Which was basically in line. So no huge surprise there.
So they sold what everyone thought they'd sell, but they kept a lot more of that money as profit than anyone expected.
That's the key.
Yeah.
And if you zoom out to the full year, revenue is up 30% to almost $978 million.
Right.
Management is calling it their strongest year ever.
Okay, but strongest year ever sounds great in a press release. We've got to be honest about where that 30% growth came from.
You're right.
They didn't just magically sell 30% more software. This was bought growth.
It was. This year was all about M&A, specifically the integration of ShareFile. And this really gets to the core identity of Progress.
Right. They're not trying to be the next viral startup. They run a very specific playbook.
They call it total growth. And it's basically a private equity strategy inside a public company.
Okay, break that down. What does total growth actually mean?
It's a cycle. Invest and innovate in their core products, and then acquire and integrate new ones. They hunt for infrastructure software, stuff that's really sticky,
The plumbing.
The plumbing for a business, exactly.
Yeah.
They buy it, they integrate it, and then, this is the crucial part, they strip out costs to hit a target operating margin of around 40%.
And looking at Q4, they nailed that margin, 38%, which was above their own guidance.
Yep. The CFO, Anthony Folger, he explicitly credited the ShareFile integration for that. And he said they passed every integration milestone ahead of schedule.
Expense discipline usually sounds like a euphemism for layoffs.
It can be.
But in this model, that efficiency, that is the product. They bought ShareFile and immediately turned it into a profit machine.
That's the business. That's why the EPS beat was so big. When you integrate faster and cheaper than you modeled, all that cash flows straight to the bottom line. It proves their M&A engine actually works.
Which is rare. Usually software acquisitions are messy.
They're a nightmare.
Culturally difficult, expensive. Progress makes it look like an assembly line.
Okay, but there's always a but.
Always.
We have to talk about organic growth.
Yeah.
If you strip away the shiny new toy, what is the core business actually doing?
And this is the friction point. This is the disconnect. You look at annualized recurring revenue, ARR, on a pro forma basis. So ignoring the acquisition.
Right, just the businesses they already owned.
It's at $852 million, and that represents only 2% year-over-year growth.
2%? I mean, that's barely inflation.
It's essentially flat. And the net retention rate, or NRR, confirms that. It's holding steady at 100%. Okay, let's unpack NRR. 100% means that for every dollar a customer spent last year, they're spending a dollar this year.
Correct.
So they're not leaving, which is good, but they're not spending anymore.
And that's the critical distinction. In the software world, you want to see NRR at like 110, 120%. You want that land and expand motion.
Where they buy one tool, then they come back for two more.
Exactly. Progress doesn't have that. Management frames 100% as solid relevance, basically saying, hey, our customers are loyal, which is true. Retention is valuable, but it is not growth.
So the market sees this split, right? On one side, you've got these beautiful 38% margins and cash flow. On the other, an organic engine that's just idling at 2%.
And that's why the valuation multiple stays compressed compared to the high flyers. It reinforces the whole thesis. Progress is a value stock, not a growth stock.
The car is moving forward, but only because they keep bolting on new engines.
Perfect analogy.
So management knows this is the knock on them. And inevitably, they spent a good chunk of the call on the only thing that matters in tech right now, AI.
Of course.
CEO Yogesh Gupta claimed the business is increasingly propelled by customers' AI projects. Is that just buzzword bingo, or is there some substance there?
You know, I'm usually super skeptical when a legacy company starts waving the AI flag, but I give them credit here. They were surprisingly realistic.
How so?
They didn't just say AI is great. They gave specific examples, like a Fortune 50 agriculture company using their data platform to unify hundreds of data sources for AI analysis.
That makes sense. You can't have good AI without clean data, garbage in, garbage out.
And they also highlighted a win with the Department of Defense. Their federal group got added to something called the Tradewinds Solutions Marketplace.
Which is what?
It's basically a pre-approved list of AI products for the DoD. Lets them bypass a lot of red tape.
Okay, so those are real wins, but did they try to claim it's moving the needle on revenue yet? Because 2% growth says it isn't.
And that was the most interesting part of the call for me, the honesty. During the Q&A, an analyst basically asked them, if you're so central to AI, why is your NRR stuck at 100%?
The obvious question, show me the money.
And management just admitted it. They said AI monetization is not showing up in the NRR figures yet.
Wow.
And the CEO used this fantastic analogy. He compared where we are right now to the dark fiber era of the dot-com bubble.
Oh, I love that. Back in '99, when companies laid thousands of miles of fiber optic cable that just sat there unused for years.
Exactly. Gupta's argument is that we're in the infrastructure phase of AI. Everyone is buying GPUs, building data centers. They're laying the modern-day fiber. But the business application layer,
where progress sits.
right, that layer's lagging. He said he doesn't expect massive spend there for another 1 to 3 years.
So the money is going to NVIDIA and the cloud providers for the plumbing. It hasn't trickled down to the application software yet.
That's his take.
Oh, yeah.
And it feels right. A lot of pilot programs, a lot of experimenting, but not a lot of huge production level spending yet.
He also made a defensive point, didn't he? About AI not replacing software.
Yeah, the software eating software thesis.
Yeah.
He argued really strongly against that. He said CIOs are not going to risk their businesses by letting an AI write their financial system.
They want stability, the 5 nines of reliability.
Exactly. Nobody ever got fired for buying IBM, right? Cool saying. He sees a defensive moat there.
It's a compelling argument. Okay, let's shift gears to the future. Forward guidance. This is where that cash flow machine narrative really gets cemented.
It does. They're approaching a pretty big milestone for fiscal 26.
The big 1 billion.
Yep. Guidance projects revenue between $986 million and an even $1 billion. Crossing that $1 billion mark is a huge psychological win.
It puts you in a different weight class with institutional investors, and the margin guidance is just relentless. They're projecting they'll sustain that 39% operating margin.
Which is incredible. So many SaaS companies are happy with 25%. And this translates to massive cash flow, guiding for $313 to $326 million in unlevered free cash flow.
That is a lot of dry powder. What do they do with it? Buy another company right away.
This is the responsible part of the story. They took on debt for ShareFile, and now they're aggressively paying it down. About $250 million in debt repayment plan for FY26.
Why the big rush to deleverage?
It's about reloading the gun. They have $900 million in unused capacity on their credit line. By paying down debt, they're clearing the decks for the next acquisition.
So it's a cycle. Buy, integrate, generate cash, pay down debt, reload, and then?
Buy again. That's the whole investment thesis right there.
And speaking of targets, the CEO dropped another interesting nugget about the private markets.
Yeah, this was telling. He said he's seeing softening retention rates in potential acquisition targets, especially startups.
Softening retention is a very polite way of saying customers are quitting.
It is. And it connects back to the AI hype. He said enterprise customers are getting scared. They're churning away from risky startups because they're afraid those startups might run out of cash.
A flight to safety. Back to stable incumbents.
Right, which is a double-edged sword for progress.
How so?
Well, on one hand, it validates them as a safe harbor. It helps them keep that 100% NRR. But on the other hand, it makes it harder for them to find good companies to buy.
Because their acquisition criteria is so strict, they want high retention.
Exactly. If all the startups are churning customers, the pool of viable companies shrinks. So they have to be patient.
Before we get to our trade idea, let's just quickly put the stock performance in context. It's been a rough year for PRGS holders.
Rough is an understatement. On a one-year basis, total return is negative 32%. Compare that to the tech ETF XLK, which is up almost 20%.
Wow, that is a massive divergence.
It really shows that split in the market we talked about.
Yeah.
The money has been chasing AI, growth, NVIDIA, Microsoft. Progress is a value and profitability play. It got left behind because it's boring.
What? Tortoise and the hare.
And the hare has been on steroids for the last 12 months. The tortoise is just sitting there, counting its cash, waiting for the hare to have a heart attack.
All right, we've looked at the past, we've looked at the guidance. Now it is time for the segment everyone waits for. This is where we pitch a trade idea. It's bold, maybe a little crazy, but it's rooted in everything we just discussed.
And the reminder? This is absolutely not financial advice. Do not do this. We are just exploring hypotheticals for entertainment.
Okay, lay it on me. What's the play?
I call this one the vulture integration spread.
The vulture integration spread.
I like it. Sounds menacing.
So here's the setup. The CEO explicitly said startups are struggling, they're churning customers. We know the AI hype is cooling for the application layer, that dark fiber lag.
And we know progress is sitting on stable margins, paying down debt, and reloading a $900 million war chest. They're the predator waiting for the prey to get weak.
Okay, so what's the trade?
The trade is this. You go long progress software, PRGS, and you go short a basket or an ETF of unprofitable, high churn AI application startups.
You're betting on the adults in the room cleaning up the mess.
You're capturing the spread between boring, profitable infrastructure and imploding AI hype. But here is the kicker.
Go on.
You are essentially betting that progress will eventually acquire one of the companies you are shorting.
Oh, that is devious. Walk me through that.
Think about it. If the startup you're shorting just collapses, your short pays off. Great. But what if it struggles and gets bought by Progress for pennies on the dollar?
Then Progress strips the costs, adds it to their machine.
And your long position on Progress benefits from the deal. So you win if the startup dies, and you potentially win if it gets eaten by the company you're long on.
It's a bet on consolidation. The party is over for free money in the valley. Now the vultures, the disciplined capital allocators like Progress, they come in to feast.
You want to be invested in the vulture, not the carcass.
That is dark, pragmatic, and it makes a scary amount of sense. The vulture integration spread.
It's a play for a specific kind of market cycle, and I think we're entering it.
Well, there you have it. A deep dive into a company that proves boring can be profitable. So, to recap, Progress Software, strongest fiscal year ever. Margins beat expectations at 38%. The ShareFile deal was integrated perfectly.
But the watch item is still at 2% organic ARR growth. Can they move that needle, or is the next leg up purely dependent on another deal? That's what you need to watch.
And hey, if you want to see the numbers for yourself, go check out the transcript. It is worth a read, even just for the CEO's comments on the dark fiber era of AI.
Absolutely. Great history lesson applied to today. See you in the next print.